preparing for an agency lending interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is agency lending in the context of securities lending? Agency lending is securities lending done by an agent bank or custodian on behalf of a beneficial owner. The lender owns the securities, the borrower needs them, usually for short covering, market making, or settlement, and the agent arranges the loan. Collateral is taken to protect the lender. Fees are earned, and the agent monitors margin, recalls, corporate actions, and returns. The key is balancing incremental revenue with controlled operational and counterparty risk. While answering, focus on definition, parties, purpose, collateral, fee income, and the agent's control role. Clarify that ownership economics remain with the beneficial owner, while temporary title or possession transfers. Question 2. Walk me through the lifecycle of an agency lending trade. The trade starts with a borrower request for a security and quantity. The agent checks lendable inventory, pricing, counterparty limits, and collateral eligibility, then agrees the loan terms. Securities are delivered against collateral, usually with over-collateralization. Daily, the agent marks both sides to market, collects or returns collateral, processes income events, and monitors recalls. At close, the borrower returns the securities and receives collateral back, with fees allocated between lender and agent. Make sure to cover the full trade lifecycle: borrower request, inventory check, trade agreement, delivery versus collateral, daily marks, income events, recalls, returns, and revenue allocation. Question 3. How is agency lending different from principal lending? In agency lending, the agent facilitates the loan for the beneficial owner and normally does not take the securities onto its own balance sheet as principal. In principal lending, the intermediary borrows or lends in its own name and assumes direct market and counterparty exposure. Agency models focus on fiduciary duties, client guidelines, indemnification scope, and transparent revenue sharing. Interviewers want to hear that legal capacity drives risk, accounting treatment, and economics. In your answer, distinguish legal capacity, balance sheet risk, fiduciary duties, economics, and indemnification. Interviewers want clarity on whether the intermediary acts as agent or principal. Question 4. Why do beneficial owners participate in securities lending programs? Beneficial owners lend because idle portfolio positions can generate incremental alpha without selling the assets. A pension fund holding large index positions, for example, can earn lending fees on securities it already plans to hold. The risks are not zero: borrower default, collateral reinvestment losses, operational errors, and temporary loss of voting rights can matter. A strong answer weighs revenue against guidelines, liquidity needs, and risk appetite. Be sure to mention incremental income, long-term holdings, utilization, borrower demand, and key risks such as default, collateral reinvestment, operational breaks, liquidity needs, voting rights, and reputational concerns. Question 5. What types of collateral are used in agency lending, and why are haircuts applied? Collateral is the lender's protection if the borrower does not return the securities. It can be cash, government bonds, high-quality equities, or letters of credit, depending on program rules. Haircuts create a cushion. For example, a $100 equity loan might require $102 or $105 of collateral. The agent then marks collateral daily and calls variation margin, because collateral quality and valuation matter as much as the initial percentage. While answering, focus on collateral types: over-collateralization, haircuts, daily valuation, eligibility schedules, concentration limits, and why collateral quality matters as much as the nominal margin percentage. Question 6. How does an agency lending program generate and allocate revenue? Revenue depends on collateral type. With non-cash collateral, the borrower typically pays a lending fee. With cash collateral, the lender pays or receives a rebate, and the spread between reinvestment yield and rebate drives income. The agent calculates gross revenue, deducts agreed splits or fees, and allocates net income to clients. The best answer also mentions specials, utilization, demand, collateral reinvestment risk, and transparent client reporting. Make sure to cover fee-based lending, cash collateral rebate mechanics, reinvestment spread, revenue splits between beneficial owner and agent, and how specials can materially increase returns. Question 7. Explain the difference between a borrow fee and a rebate rate. Think of the borrow cost as the price of accessing a scarce security. For non-cash collateral, it is usually quoted as a fee in basis points paid by the borrower. For cash collateral, the rebate rate determines how much interest is returned to the borrower. A lower or negative rebate means the lender earns more. Fees move with supply, demand, short interest, liquidity, corporate events, and overall funding conditions. In your answer, explain borrow fee, rebate rate, cash versus non-cash collateral, supply-demand drivers, negative rebates, and how pricing changes for general collateral versus hard-to-borrow securities. Question 8. How are dividends, corporate actions, and proxy voting handled when securities are on loan? Loaned securities still belong economically to the beneficial owner, so the program must preserve income and corporate action entitlements. If a dividend is paid while securities are on loan, the borrower makes a manufactured payment to the lender. For voluntary events or proxy votes, the lender may need to recall securities before record date. I would highlight deadlines, tax treatment, client instructions, and operational controls around event processing. Be sure to mention manufactured dividends, tax treatment, record dates, voluntary corporate actions, proxy voting, recalls, and how operations ensures the beneficial owner receives equivalent economic benefits. Question 9. Why is daily mark-to-market important in agency lending? Daily mark-to-market keeps the lender protected as security prices and collateral values move. If the loan security rises, the borrower usually posts more collateral. If it falls, excess collateral may be returned. The agent compares required collateral against actual collateral using agreed haircuts, currencies, and eligibility rules. Timely margining reduces loss severity in a borrower default and is one of the core daily controls globally. While answering, focus on daily mark-to-market, required collateral calculations, variation margin, price movements, currency effects, dispute handling, and how margin discipline reduces borrower default exposure. Question 10. How would you manage counterparty risk in an agency lending program? Counterparty risk is the risk the borrower cannot return securities when due. I would control it through approved borrower lists, credit limits, exposure monitoring, collateral eligibility, concentration limits, and legal agreements such as GMSLA or MSLA. Many agent lenders also provide indemnification, but usually only for borrower default, not reinvestment losses. The point is that strong collateral does not replace borrower credit discipline or documentation. Make sure to cover borrower approval, credit limits, collateral rules, legal agreements, exposure monitoring, indemnification scope, and why counterparty assessment remains critical even with over-collateralization. Question 11. What happens when a lender recalls a security that is currently on loan? A recall is the lender's instruction for the borrower to return securities, often because the client wants to sell, vote, or restrict lending. The agent sends the recall, tracks contractual settlement timing, and escalates if the borrower is late. If a fail occurs, the team manages buy-in exposure, substitute collateral, client communication, and market claims. The interviewer is testing whether you connect trading, custody, and settlement operations. In your answer, talk about why recalls happen, notice periods, borrower obligations, escalation of late returns, settlement fails, buy-ins, market claims, and client communication. Question 12. How does agency lending support short selling and market liquidity? Securities lending is essential plumbing for short selling. A short seller borrows shares, sells them in the market, and later buys shares back to return them. The loan gives settlement certainty and reduces naked short risk. From the agent lender's perspective, demand from short sellers can create attractive fees, especially in hard-to-borrow names. But the program still must respect client restrictions, recalls, and regulatory rules. Be sure to connect agency lending with short selling, market making, settlement liquidity, locate requirements, hard to borrow demand, regulatory constraints, and the lender's need for recall flexibility. Question 13. What is the difference between general collateral and specials in securities lending? General collateral securities are easy to borrow because supply is broad and demand is normal, so fees are low. Specials are scarce or highly demanded securities, often due to short interest, corporate events, index changes, or settlement pressure. Utilization and fee levels are much higher in specials. A practical answer should explain that specials drive a disproportionate share of lending revenue but need tighter monitoring. While answering, compare availability, demand, utilization, fee levels, revenue contribution, and risk monitoring. Explain why special securities can generate high returns but require closer operational attention. Question 14. What operational controls are most important in agency lending? In operations, I would prioritize completeness, accuracy, and timeliness. Key controls include trade capture checks, position and collateral reconciliations, exception management, income claim matching, corporate action monitoring, margin call aging, and borrower exposure reporting. Breaks should be assigned owners and deadlines, not just listed. Good agency lending operations prevent small breaks from becoming client-impacting losses or regulatory issues during high-volume market days or audits alike. Make sure to cover reconciliations across positions, trades, collateral, income, corporate actions, margin calls, and exposure limits. Emphasize exception ownership, aging, escalation, and audit evidence. Question 15. If a borrower defaults or fails to return securities, what steps would you take? If a borrower fails to return securities, I would first confirm the contractual default trigger and freeze further lending to that borrower. Then I would value the exposure, apply collateral, source replacement securities, or execute a buy-in if required, and notify credit, legal, risk, and the client. Any shortfall may fall under indemnification if covered. The answer should show calm escalation, documentation, and client protection. In your answer, structure the response as an escalation plan. Confirm default, value exposure, use collateral, arrange buy-in or replacement, notify stakeholders, check indemnification, and document actions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.